Good day, fellow investors. My name is Sven Carlin, and today we'll take a look at the top 10 gold miners in the world in order to find the best fit for your portfolio. I find research fundamental in investing. The more you know about a company, about a sector, about what's going on in the economy, the higher will your investing returns be, the lower will be your risk. Every miner is different. There is no mine equal to another mine in the whole world. Therefore, every miner has specific problems, has different debt structures. There are more leveraged miners. There are miners without debt, with high cash flows. Stock prices vary enormously among miners. Leveraged ones, they need gold prices to increase immediately. Unleveraged ones, they are pretty stable, pay out dividends, and you can easily calculate what will happen in the future. And they are less exposed to fluctuations in the price of gold. You have to see what fits best into your portfolio. Maybe you want to allocate 1% of your portfolio into a risky gold miner, and then do it every 6 months, every year, depends how the situation evolves. Or maybe you want to allocate 3-4% of your portfolio into a safe miner and then forget about it for the next 10 to 20 years. I'll dissect these 10 mining companies so you will see what appeals to you and what should you look in these 10 miners or in some other mine. We're going to talk about debt. The higher the leverage, the higher the risk. We're going to talk about reserves. The more reserves there are in the ground, the stronger is the position of the miner and the long-term horizon of the investment. On top of the reserves, there are also mining costs. Deep reserves, higher mining costs. Higher mining costs need a higher price of gold. And on top of everything, there are always political risks, there are military risks, there are environmental risks. Some people don't like Africa because governments change very quickly. Some people don't like the US as a mining country because of the environmental problems and issues you find when you want to develop a mine. I'll start with Barrick Gold, which is one of the largest gold miners in the world. Barrick Gold is profitable when gold prices are above $1,000 per ounce, so it gives a pretty large margin of safety. However, 67% of Barrick's assets are financed by debt. So if gold prices go below $1,000, even for a shorter period of time, Barrick Gold would go into trouble and its stock price would go extremely low. The company's goal is to lower their debt by $5 billion by 2019. Apart from the debt, Barrick Gold has a huge pipeline of projects development. So if you're looking for a long-term gold investment, Barrick Gold should definitely be an option. Trailing earnings are $1.21 per share, PE ratio is 14.5 and the price to book value is 2.2. Newmont Mining Corporation is also a great miner with a diversified portfolio of mines all over the world, is a bit less leveraged than Barrick Gold with only 47% of assets financed by debt. As you can see in the chart, Newmont's production is expected to be stable for the foreseeable future. This means that you can expect stable cash flows, low risk, something similarly to what is the case with Barrick. However, there are some current issues. Newmont had to impair $1.2 billion for its Peruvian Yanacocha mine, and there are other issues with its Conga mine. So there are always issues with mines. As we continue with the video, you will see more about that. Newcrest Mining is an Australian gold miner. Newcrest has one of the longest reserve lives on the planet. So if you're really looking for a stable long-term gold investment, Newcrest is better than Newmont and Barrick. However, you're less exposed to gold price volatility, negative or positive. Newcrest Mining has also its fair shares of issues. Their top mine, Cadia, is in a seismically active territory, so you never know when something bad can happen. Their main project is in New Papua Guinea, so political issues are still there. They don't know how much will they have to pay in taxes when they develop the project, what part will be owned by the government, and issues like that. But for the long term, they have a lot of projects, so you can be secure. On top of that, it's traded in Australia, so it's outside of the bubble Wall Street lives in, so it's not so expensive as the previous two miners that we discussed. GOLDCORP is a different miner. It's a more aggressive miner. It just spent $725 million on acquisitions. And those acquisitions are risky acquisitions because the mines bought have an average grade of 0.5 grams of gold per ton, which is much lower than Barrick's 1.3 grams per ton. Low grams per ton mean higher mining costs. That means that GOLDCORP is targeting higher future gold prices. So they're making a bet. So if you want to bet on higher future gold prices, GOLDCORP is the company for you. However, GOLDCORP's current operations are very profitable. You can see on the chart that they have a lot of projects, a lot of mines, very well geographical, diversified, and they have only 47% of assets financed by debt. So they are planning to explore further these mines, grow organically, and I would expect GOLDCORP to be around for a long time. In addition, as I said, low debt and the new projects, the acquisitions, give high potential for GOLDCORP to increase in value as gold prices go up. Agnico Eagle Mines is a Canadian miner with operations in Canada, Mexico and Finland. It has very low debt, 35% of assets are financed by debt, and of those 45%, 50% are just deferred taxes. So it's a low debt miner. What separates Agnico from other companies is the extremely high mineral reserve grade of 2.41 grams per ton. Higher grade means lower mining costs. However, this makes also the company a little bit more expensive with a price to cash flow ratio of 13.6. But if you want stability, this is the company for you. KINROA's GOLDCORP is the first miner that I'm discussing that really depends on higher gold prices. They are selling some assets in order to finance development projects, but they are just trying to keep their head above water. What can save them are higher gold prices. Their stock would go to the skies if there would be higher gold prices. RANDGOLD Resources is a very interesting miner. Its operations are focused on Africa. It is extremely profitable. It has no debt because it invests only in projects that are profitable with an internal rate of return above 20% at gold prices at $1,000 per ounce. Gold prices are now at 1,260. So it's an extremely conservative company, but its mines are located in Africa. As you can see, their footprint is mainly in Africa, so it depends on political issues, wars, or whatever can happen there. The market is not that scared about what can happen because RANDGOLD is one of the most expensive miners we have discussed up till now. Profitability, cash flows, so if you want that, RANDGOLD is your company. AngloGold Ashanti is a South African miner. It has 17 mines in 9 countries, but is a miner that has a lot of fatalities. On average, 8 people die per year in their mines. Also, its costs are very high, so only higher gold price could save the company. GOLDFIELDS is another company where everything depends on higher gold prices. So if you invest now, you might lose your money in the next year, but then you will be ready to invest in another miner. If gold prices go up, everything GOLDFIELDS owns becomes much more valuable, and it's easy for the stock price to increase 10 times or even 20 if gold prices shoot up. The last miner I want to talk about is ELDORADO. ELDORADO is a completely different miner because it's focused on growth and developing new projects. ELDORADO's development projects are in Turkey, Greece, and it recently acquired a new project. What is interesting is that the market doesn't like projects because projects are uncertain. This makes the company extremely cheap. The market likes to value what is here, what's working. They don't like to think about what will happen in the future. Of course, if it's not Tesla's stock. As Wall Street doesn't like projects, they hate uncertainty, ELDORADO's stock price is just $3.55, while its book value is $4.87. So there is a margin of safety in the book value of the company. And if ELDORADO delivers on its projects, the potential upside is huge. Let's take a look at this chart. It shows how much could ELDORADO grow in the future, especially if gold prices go up. On top of the potential, ELDORADO has just 27% of its assets financed by debt. Such a miner is for those who really want to hit the jackpot. If you buy now and ELDORADO delivers, gold prices increase, you're looking at a miner that could easily go up 10, 20 or even 30 times from its current price, as it becomes one of the greatest miners in the world. The problem is that there will be many things that will go wrong. Something will go wrong at each of these projects shown in this chart. So, to conclude, ELDORADO, high growth potential, mining includes always risks, they operate in Turkey, Greece, which are not the safest environments. It's up to you to see which one is the best. To conclude, these are just the 10 top miners in the world. There are many more miners. So if you really want to expose your portfolio to a low-risk miner with huge potential, I suggest you dig into gold miners. Most people buy gold through ETFs. That's extremely stupid because you buy a little bit of everything, and we have just seen how the world of gold miners is extremely different. And each miner adds different risks to your portfolio. Buying a bunch of everything just tells you that you don't want to think about what you're doing, you don't want to think about how that affects your portfolio, and you don't want to think about if you own a miner that is destroying value, creating value, risk, not risk. So I would suggest that you find a few miners, 2, 3, 4 miners. They give good diversification to a complete portfolio and allow for a good hedge in case there is a financial crisis. Thank you for watching. If you like the content, please click like, subscribe for more, and if you have questions, please comment below.